Welcome to the Orbit. It is Monday, July 15th. We've got stocks higher to start the week. We are up almost 0.75% in SPX to start the week. You can see how that compares to the last couple of days. This is a new high, a little bit potential of a breakout. We've had some of these down moves, and there's been some funkiness in the market with a little bit of divergence day to day. Since that CPI print, we've had IWM, for example, outperforming all the other indices and pretty much flying higher. And if you go out to a one-year chart, this is not an all-time high. It's not far away from an all-time high, which came back during the COVID era. But as you can see, it's a breakout and a multi-year high, and a breakout from a range that IWM had been in around that 200 level. 210, it failed out a couple of times. In those moments when it did fail at 210, it was kind of interesting. If you look back on some of the treasury yields, IWM is obviously very treasury yield dependent. It was a reversal in treasury years. IWM was strong, the treasury yields were falling, treasury yields stopped and started rising again, and then IWM's breakout attempt failed. In this case, treasury yields are now lower than where they were at the other points where IWM tried to break out above 210. And a lot of it probably will be dependent. This breakout, this rally, how far it goes. If it fails at some point, will probably be dependent on that. Speaking of that, we've got, let's go to TLT, which is, of course, the 20-year treasury. And we've got that down today, and we are at about 93. We've been talking about over the last couple of months how important that 90 level was. And you can see the few times when we've gone below that and we've reversed hard, we are not back to these highs around 95. So keep an eye on that. And then obviously keep an eye on those 2 years, 10 years, things like that. Talking about the divergence, certain divergent days we saw where you might have small caps higher and mega caps lower last week. Are those actual rotations? Or are those just day-to-day type divergence? We've got Qs right at 500. If you go to the 1 week chart, that is lower than it was late last week on Thursday. But it's trying to rebound to start this week, and we're up about 1%. Going back to SPX real quick, that up 0.75%, up actually up 0.8 now. The expected move coming into the week for the entire week, all 5 trading days, was just over 1% coming into the week. So we were almost up at that level already. As you can see, the expected move for the rest of the day is 0.3%. You go out to the week, the expected move is just under 1%, about 0.9%. You see that up here in the upper left of the chart. And, that would, just from a levels standpoint, we are looking at 56.10 to the downside and 57.10 to the upside. That 0.3 expected move for the rest of the day, let's go into an iron condor. We've got the 56.75 short call, 56.40 short put. Take that a little bit wider. Let's get that up to 56.85, 56.30. You can see that 4-to-1 risk ratio. Let's go to the end of the week, Friday, that's the 19th, and this is the monthly expiry, by the way. And you can see that those levels, just based on the expected move, that's what we were just talking about, the 57.10, 56.10. You take that a little bit wider and maybe get the 5600 level on the downside. And in a low vol environment like this, a lot of times if you are a premium seller, you have to be careful of these lazy rallies higher where all of a sudden you turn around and the market's up 1%. And options, have a difficult time pricing those sorts of grinds higher. So you have to be careful to the upside. Now that you've gotten this move, it's a little bit, selling upside call spreads, let's say, it's a little bit safer because you've waited and you've already got that initial move. It tends to, in low vol environments, heavy gamma in the market, as long as we don't do a big reversal or as long as the market doesn't rally so fast into some potential negative gamma, it makes that first move. It might go sideways for a couple of days. So the market tends to cooperate. Options are, low vol options tend to be right in the near term as far as market movement. But then again, you have that weekend effect You start the week off with low vol. A lot of earnings reports this week. You've got Netflix, which leads it midweek, leads the headlines, but you've got a lot starting to report. In a low vol environment, you are less likely to see those big 25% moves in big cap tech stocks, and for instance, just because they also are loaded with gamma in a lot of cases.